this big word out there, this big word, what's about that? What is about recession? What's that? How do we measure that? How do we identify that? I mean, it's a big word. So today, let's try to analyze some data. Let's try to use cycles. And in specific, is Main Street the cause of what happens on Wall Street, or vice versa? So who is driving what? Is the business cycle driving the financial cycles, or the other way around? Or do they go in sync? So today we focus on the business cycle perspective, and I will introduce some interesting data, and for sure, let's do some interesting analysis. So, we need to talk.
From the mind of Lars von Tienen, the most advanced cycle analysis, hot off the press.
Yeah, as introduced, recession and some business cycle economics. That's the topic for today. Thanks for joining another episode of Cycles TV. We will spend the next 20 minutes to analyze a little bit business cycle dynamics. Yes, business cycle. So before I dive into the details of the data set we will analyze today, let's first make sure that we are on the same page. So often we analyze cycles on Wall Street. Yeah, so we use stock market data, we use the big indices, we try to identify cycles in that. These are financial cycles on Wall Street. So, but for sure, there's also the so-called business cycle. What happens on Main Street? So we have the business cycle, Main Street. We have the financial cycles, Wall Street. Often they go in sync. Yeah, and as an cycle analyst, we try to identify the points in time when either the financial cycle or the business cycle might peak, yeah, or might be in a bottom state. So that's what we try to isolate with our cyclic idea. But we also need to be aware that the business cycle and the financial cycle not always go in sync. And especially on that big word, recession, we need to have more attention to the business cycle, because there it's mainly revealed. The financial cycle is then more reaction on that. So therefore, hopefully you get those two terms. Today I will dive more into the specifics of the business cycle, and in the end I will get back to this big word. Okay, so the chat section is open. If you want to throw in your questions, feel free to do so. Okay, the business cycle. Often we refer to the business cycle, or we measure the business cycle on Main Street in the terms of the gross domestic product, GDP. Yeah, this is what is measured, what is reported. But if we have a closer look also about what are the sectors of the GDP, as we can see here, it's divided into different sectors here. And two sectors in specific are very important in terms of cyclic activity and in terms having a leading qualifier. So, and this is about construction and manufacturing. Construction and manufacturing are the two sectors within the GDP which are very sensitive to monetary policies. So if interest rates or some terms of the policies change, they react very quickly to those policy changes in the monetary system. And I mean, they produce the goods. So they are also in the secondary economic sector, as we talk. So the first sector is extracting raw material. The secondary sector then is producing goods like in construction and manufacturing. And the third sector is about the service industry, the financial industry. So the engine of Main Street is production within manufacturing and construction. So, and that counts up to 15% of the GDP. But this is a leading Main Street information we get. And it is reported monthly. So GDP is only quarterly. We won't have a lower frequency. So therefore, the figures of construction and manufacturing are reported also in the frequency of monthly data. So we have even more regular data. So let's start from there. If you do your research on the influence of construction and manufacturing in the business cycle, you will find that there's a lot of evidence that those two sectors within the economy, business cycle, Main Street, first, they are leading. So if something happens there first, it will spill over in a lot of other sectors afterwards. So it's a leading information. Second, they react very cyclical. So they have those ups and downs within their industry. And third, they are very sensitive to the monetary policy outside. So interest rate changes from the policy regime. So that makes it very interesting to not look at the GDP as a total and on a quarterly basis. That's very lagging, much too late, will not give us any clue about where we are today as a kind of leading information. But as we now zoom in into construction and manufacturing on a monthly basis, we have much better information at hand than just the overall GDP. So what I will now do is I will show you how we grab the data from construction manufacturing, put this into a kind of economic index, and then apply our cycle analysis on that, right? And then let's see what we see. Okay, so that's just the intro. That data is available on public websites. So we could use, let me walk you through, we could use the US census data here as shown here from the government, which provides all the data on GDP information and economic information. They also provided data on just construction spending. It looks like you can download it as Excel, whatever. So all the data is right at our hands. This is how it looks like if you then drill down into the monthly data. So what I'm interested in for now is the total construction per month. So this value is published every month, and we have history going back into, 1940s, 1960s, something like that. So we have lots of historical data on that. So we use the total construction, which is a kind of output of the business cycle. So let's call it the output of the current Main Street business cycle within that month. We can measure it, it's reported, there is public data available, and we can measure the growth, the contraction, the expansion in that data, so we can see it. So that's for construction. It's all there. Second, you all know that I like the Fed, Federal Reserve Bank of St. Louis. They are also providing a lot of economic data series. And here for manufacturing, in that sense, I want to use a slight different data set, not the real output, but they also measure all employees working in that sector. So that's also great. So I want to, and this is also available going back into 1940, 1950. From today, it's also reported in a monthly way. And I'm interested here at the percent change from a year ago. So what you're seeing here is the, let's call it the momentum within the manufacturing sector. Yeah. So because it's the change of employees in that sector measured, so the change where they have been a year ago, yeah, measured months by months. So we measure now the change in total production outcome from the construction sector. We measure the yearly change month by month, and we do the same for all employees in the manufacturing area. So this gives us a zoom-in perspective, a data perspective, in what's happening in the business cycle, specifically using construction and manufacturing as the cyclic leading data series on a monthly basis. Not the raw absolute values, as mentioned. We will look at the yearly change month by month. So the change from a year ago in that data series, which is a kind of momentum. So we measure the expansion and the contraction in that data series. So I make this a composite data series. Yeah, we just aggregate the raw data I showed you. We do build an average so that we have one aggregated business cycle series, which is the key series from construction and manufacturing and the change on that. I mean, I think you get the message. You can build this data set on your own. It's no secret about that data set. So I created that data series going back into 1960, 1970, created the aggregate, changed the, have a look at the yearly rate of change going forward month by month. And after all this was done from preparing the data, I have uploaded that into our cycle analyzer. As first I was interested, is there cyclic behavior in the momentum for construction and manufacturing, which is the core of the business cycle? I mean, I don't know, but that's the question we raise as a cycle analyst, right? We want to identify, is there a cycle which can maybe pinpoint or give us an indication about when there might be a change in trend in that momentum for those sectors. Yeah, so that's it. So let's have a look at the data. So here is the raw data. Yeah, so I call this the Conman index. It's the US economy business cycle momentum index based on those two data series, public available from Fred and census.gov. So yeah, as you can see here, we can dive in. It's a monthly series, so we need to be aware of that this is a monthly series. We are going back here to 1965, so 50, 60 years. So we have right enough data to really run cycle analysis, so that makes it pretty nice. Yeah, and let's have a look at our cycle scanner first. So at the lower left, as always, we now see the spectrum for that business cycle zoom-in perspective. And we see highlighted also the peaks. I mean, we can visually identify them here with a length of 67 months and a clear dominant cycle of 109 months, which is shown here. So I mean, without knowing what data set here, looking at that kind of spectrum is, we need to now verify our basic rule set, how to identify cycles. Yeah? So therefore, we have a look at the shape of the spectrum, or of the peak within the spectrum, which is we always want to see here peaks which are very sharp, so which have a very high roll off to the left and to the right. In best case, going down to the x-axis of the spectrum, which is mainly the case for those three cycles here. So then we have really nothing here between 150 and 200. Then very flat. That's a good example of a very flat plateau here. So we could measure a peak, but I always never would recommend use these kinds of peak here because it's too flat. from the visual shape here in the spectrum. And by the way, that's also a good example to explain. You see here, it is listed as a peak here in the second row. It's 249 months, but you see it has not received a dominant ranking from our ranking score, and the ranking score qualifies that cycle based on the shape, the visual shape in the real spectrum, so the frequency analysis domain, which is important for what we're doing here. So, and even though it has a high stability, it has not received a ranking from the way how the shape is formed in the spectrum. So the ranking shows we should not trust it, while stability looks quite good. So here's a good example which should disqualify that cycle to use for further analysis. And that's why those two measures, stability and ranking, are quite important. But just a side note. So, which leaves us with the cycle of 67, which is ranked number 1. So the shape in the spectrum is very, very nice, and the stability is above the threshold of 0.5. So we have low variability over time of that cycle, which is also a second criteria. And we have that most dominant cycle. It's on top of the list. It's the most stable cycle in terms of variability, and it has a nice shape in our frequency analysis, which is shown with a ranking score of 2. So, yes, we can identify cycles in this business cycle data set, which is at first, without now putting an overlay or doing any projection with that information, there are clear cycles which can be isolated. Just reading the data, which is great being a cycle analyst. So, okay, I said that. Let's now try, as we can identify, or quick summary, 2 cycles qualify for further analysis, which is the 109 months and the 67 months. All the other 2 disqualify here based on stability and ranking. I hope that's clear. So let's start with the longest cycle, which is coming from 109 months in that case. So let's have a look here, and which forms nicely, and aligns nicely with previous peaks and bottoms in the underlying business cycle momentum data series, which is, should be by design because it was identified. And I think if we even zoom in, we see clear the lows, even the peaks here during that period here, another low on the peak in that period here, another peak here. So that looks quite in sync with the business data. We can do now also the same with the second cycle. I don't want to make it too complex, but if we activate that, we see it's even getting better. And that's what I always recommend. Try to isolate the most 2, maybe 3 cycles. In most cases, that's sufficient for our projection, and more cycles does not make your composite cycle analysis better, or would not make your projection any better. So not more data, not more cycles is always better. If you can isolate the most important 1, 2, 3 dominant cycles in a data series, you can even see, you can model almost 90% of the changes in trend from the data series based on 1, 2, maybe 3 cycles. And if you have good stability scores, good ranking in the frequency domain, good fit with phasing on the overall series, at least we can clearly validate that we can measure cyclic behavior. And that's currently what we're doing here. So I'm not done with my story here. I just want to conclude. Okay, first we've built the data series. I explained why for the business cycle. Second, we did run our cycle analysis. We isolated and identified 2 cycles by our standard procedure. We are always applying the same procedure. This is what I'm repeating here, week by week, clear rules how to identify and isolate the cycles. Now, as we have isolated those cycles, we can move to our next step, which then deals with projections and how to interpret that cycle and the raw data in combination. So that's what we now need to do. So let's go back to the data series for a moment, because before I talk about the projection area here, which we are in a downswing, that's I mean, one reading, that's clear, which will even continue into 2026. And that downswing has already started way back. So we can see that that we have contraction in construction and manufacturing sector. But as we measure momentum here, there's also a second information which is very important, reading that cyclic information, because the zero line, we are dealing here with a kind of momentum data series. We are not dealing with the raw absolute values of the output of construction or the absolute employees working in that sector. We are talking about the momentum in that sector. So therefore the zero line, I can even mark it here. So the zero line becomes even more important, because when the momentum is, ignore the cycle for a moment, when the momentum is above zero, that means that the business cycle is still expanding. I mean, maybe not expanding that much from a year or months before, if we are in a downswing. So the expansion might shrink, but it's still growing. It's in total it's growing. But once we pass the zero line, it's not in expansion mode anymore. Then we switch to contraction. So then the whole sector is shrinking because the momentum has gone below zero. So the zero line here plays also a very important role when we now start to try to get sense out of that data and the cyclic information. So and that's also the same now trying to read the cyclic picture we are seeing here. So we have identified, let's call it momentum cycles in business activity, the key business activity data set. We have identified cycles in momentum. We can identify when we expect the momentum to peak, but when momentum peaks and starts to go down, this still means that the sector is in expansion mode, at least until the data is above zero. When we then move below the zero line with a downswing of the cycle, and the cycle might indicate it still might continue, from that point, so crossing the zero line to the downside, in the cycling upswing, cyclic downswing period, that means now we have real contraction. The sector is in real terms now shrinking. So therefore, that crossing of the zero line now also is a very second feature, which we need to talk a little bit later on. So we can now, let's try to conclude on that. Two things are quite important. We can identify the points in time when we think that momentum in business activity might peak, like here, or like here. And we can identify, or the cycle helps us in identifying the points in times when it's not only peaking and maybe going down, or the same, bottoming and going up. So we can also isolate the points in time when that data series is rising above zero. So we expect that sector to expand, so real expansion, it's above zero, and then maybe a point, and from here it moves. And you see also here, the cycles is turning down, but it still stays above the zero line. So that means the sector is still stabilizing. The growth is maybe not as fast as before, but momentum is positive here, and even the cycle stays above zero. So even though we have downswings here from a cyclic perspective, that whole time period, this whole time period, I need to be careful where the zero line is, to be honest. So it's I try to put it in, it's here now. So this time, when we stay above the zero line here, going down, this is not a signal for contraction. That only starts from here, but now the cycle turns up, even goes to zero. So all that period here could be questioned as we are cycling around the zero line. Interesting points in time are like this. So when we had a huge expected momentum peak and then a huge drawdown, and when we reach that point here, even going down further, that means we have real contraction from a cyclic perspective and the real data. So we need to observe or monitor now two things, and we need to analyze this also going back. So I mean, we cannot draw conclusions just looking at the current situation. We need now to analyze those points in the past when that happened. So we had, from a cyclic perspective, negative periods. So the composite cycle was below zero. I'm not interested in the absolute turn here. So in that case, we are not interested in the turn, which might be the opposite in financial cycles. In momentum cycles here, we know that momentum might shift, but it stays negative or positive. So when momentum shifts to the upside and then crosses the zero line, or the other way around, when momentum starts to drop and then crosses the zero line downside, those are the points. And long story short, this is now what I want to do next, to analyze in the past what was the economic condition at these points in time. Because if there was something similar in the overall economy, the business cycle, at those points in time, which we now can isolate with the data series and which we can now measure in terms of time with our cycles, that would become even more important. So the next step is, let's specifically look at the points in time when the momentum series and the cycles cross the 0 point. Okay, I think you got it. So let's move on. I need to switch the visualization perspective a little bit to make that more readable for you. So here we are. I think that's the same cycle, just visualized in a different form. Yeah, the two monthly cycles, the raw data set. This is what we discussed so far. So next, I'm just highlighting the areas when we are, from a cyclic perspective, below the 0 line. Yeah, you can see it's now colored in light red. And when we are above the cycle, it's colored in light green. And if both overlays, it's even getting a little bit more darker in the red. So, but let's continue. It just helps us to isolate the point in time when we are in the red area and with the cycle, and when we are in the upper area of that cycle. So, and as said, we want to see what is important in this points in time here. So, and now here in gray, you see that I have marked, and I will explain in a moment just what this is. When we have the cyclic, the time period below 0, crossing below the 0 line. Here, a gray zone. Here is a gray zone. I hope you can see it with my mouse here. Then here we have two isolated periods in time when we are in the downswing cycle. So here and here. The next situation happened here. So at that point in time when we crossed down below in the red area when we had the cyclic downswing. So then here we had the period where we had the red downswing, yeah, but the real data then only crossed below the 0 line at this point in time here when we have been in the downswing composite cycle phase. So that's that point here. So then we have here, we touched down, by the way, in an upswing cycle. So, but that's what I said. To isolate the points in time, we need to go beyond the zero line when we are in a red downswing momentum phase of that cycle, which is then another gray zone here. And then we have the next downswing zone here, where we have been below the zero line here. So, and now you can guess what? What are those gray areas? I mean, I told you from a data series what we are looking for. Yeah, so in the downswing momentum composite cycle, crossing from the raw data below the zero line, from above below. I've shown you all the points. So the gray zones have been a little bit, sometimes a little bit more smaller and sometimes a little bit more wider. Maybe you could argue, yeah, you've just marked them on the chart. No. These gray zones are the official times when the US was in a recession. So it's just an overlay. So I have just made an overlay here. The periods in time when the US was officially labeled as in recession, which is officially data which is published for sure only after the fact. So those periods in time can only be measured after the fact. So, and what is a recession? That's all defined. And then after the fact, the National Institute for Business Cycle or whatever publishes those data, and those gray zones are always in the Fred data. They are always gray shaded. I just did the same. So I just overlaid that indicator I created with the composite cycle we measured with the official periods of time when the US was in a recession. It's not my definition when the US was in a recession or not. You can also look this up. Yeah, that's the gray zone. But now, and I mean, at all points in time, looking at that indicator series, when it crossed below zero, when the composite cycle was indicating we have negative momentum for that in that business cycle period, there was a recession in the US. That's data, pure data. It's not guessing. That's what the data tells us. And there was not really one instance when this was not the case. So now, the latest data we see on the right side is July. Yeah, I mean, you see it in the chat. I mean, officially, this will only be announced right after the fact. So, but you see what the data indicates here, right? The latest data point here is July 2025. We don't have August data right now. I think they will publish the August data at the end of September, so beginning of October. So in a week we will have also the August data, but we have July. So that's the blue line here. And we are, since early 2025, in a time window, yeah, when we expect momentum in that business cycle to be negative. And we now, the real data now entered that negative territory. And we are now aware of what after the fact has always been labeled as a recession. I mean, I don't know if there will be a recession. This is just analyzing data, right? But it's quite interesting. So if you, and let's maybe step aside for a moment. I introduced this episode also with the difference of Main Street, business cycle, and Wall Street, financial cycle. So the issue we are all facing is with just looking at the Wall Street financial data, and then the data is so skewed with the S&P 500, with the tech indices, with the capital-weighted big indices, where just, I don't know, a handful of companies makes up the whole ups and downs within that index. So even in financial series Wall Street, we have a situation where the data is so skewed towards the high capital companies that I think it's even hard to measure what happens at Wall Street. So let's zoom out a moment. Let's switch to the business cycle. They are interconnected anyhow. Let's switch to the business cycle. The most important components, construction, manufacturing, I mean, that's the real production happening in the US, measured in the US. And we see contracting data since 2023. Yeah, so the peak here was 2023, 2024. So it was contracting now for a longer time, so it could be observed. But again, as long as it stayed above zero and we have been in that positive cyclic momentum stage, there was even growth, yeah, which is okay. I mean, the growth rate was getting lower and lower, but still growth there. But now since some months, and this could create some trouble for the other sectors. I mean, if you look at, again, GDP, if you look at the economic first, second, and third sector, how economic works in those three sectors. And if you see now in the second sector, it's really contracting below zero. This always, or in most cases, could really cause trouble in the other sectors, which then could influence financial and other industries going up. So, and Ahi Zapatista, you showed it in the chat section. That's now your answer to the question, are we in a recession or not? I think the formal answer we will only see in a year or maybe 2 years when the official label kicks in. But we should have a warning. At least the data gives us a clear warning, and to pay attention to those business cycle economics, which is more neutral data we can monitor right now. It's not as skewed as the tech companies in the S&P 500, which screw up every data series, every neutral analysis. It's really problematic these days at the Wall Street for financial cycles. But the business data is still there. The business data is not skewed. And this is a common sense on how business cycle dynamics work. We have measured it. We know where we are. And we have seen what happened in the past at those points in time. So from here, I think I'm now repeating the message. So I think I hope you got the picture. Yeah, I will put some attention to your questions here. I hope I inspired you a little bit about digging into business cycle dynamics. I mean, that's why we are here as the foundation for the study of cycles. We want to inspire you to analyze cycles in economic Wall Street data series. And then, as I try to walk you through, to find maybe circumstances or conditions in the past when cycles and the raw data gave you an indication about something. And if you then can maybe see that in the real economy also, then you are on something as cycle analyst. That's why we're here. And this is our daily routine, checking for cycles in business, economic, or financial data series. Yeah, now it's up to you to dig in more, do some more analysis on that, or feel free to put in your questions down below. I will monitor that, and I'm interested on what you think about that. If you want to see and learn more, if you're new to the channel, do us a favor, subscribe, like the channel. This helps us grow a little bit and spread the word on cycle analysis. All right, thank you. Let me now check the questions. Yeah. Let's pick this question here first, because that's related to what we just have discussed here, Archie. I have recently found you and impressed. Thank you. Can you expand a bit on why that 109th and 60-month cycle created a cycle with large and small amplitudes? What drives that? So, Archie, thank you for that question. Maybe I've been too quick or have just rushed through the data. Let's get back and let me try to give you some explanations on that. Let me hide your question first. So I hope you got the information. I explained you why the 109-month cycle and 67 months cycle. So that's this one here. So they both, and that's by design how we detect those cycles. They both have different amplitudes, which is also shown here. So the 109-month cycle has measured or theoretical amplitude of 100, while the 67-month cycle has an amplitude of 87. So the amplitude is smaller for the 87-month cycle than the amplitude for the 109-month cycle. You can also measure this with strengths. So even though the amplitude is lower, if you divide the amplitude by length, you get a measure on how much that cycle is driving price per data point or per month. So which shows you then that cycle is even more important or has more impact on the cyclic behavior, but not talking about the strength here. So, and if you now would put both cycles, Archie, back to your question, if you now would put both cycles on an individual chart, so one cycle with an amplitude of 100, and below that, the other cycle with the amplitude of 87, so it's a little bit smaller. You can visualize both cycles individually with a large and a small amplitude. If you now just add up both cycles, you just add them up to show you them as one composite instead of two isolated cycles. That gives you the composite, which then looks like those two swings. So these ups and downs with large and small amplitudes is driven by the digital signal processing, which detects which cycle has a higher influence or a lower influence. And if you add that up, it will look like you have those different bigger or smaller amplitudes. I hope that explains it regarding to your questions. But, and this is an important but, the amplitude per se is not as important for us as cycle analysts, because we are looking at the moments in time when the composite or the individual cycle turns, regardless of we have a huge amplitude or just a small amplitude. So therefore, amplitude is one thing, but in terms of we don't use it for any price projections. So therefore, that's just explaining why you see the different amplitudes in the composite. However, don't pay too much attention as we are just isolating the changes in the composite. And I think I explained how I read the data, but so I leave it up to you to make your own conclusion. But I would read it that way. Yeah, I mean, thank you for pulling out all the questions here. So, but I can't and I don't want to pay too much attention on all those bullish, bearish analysts out there if we are heading into a recession. I mean, that might be a fair conclusion. So if we continue the data series I showed, I mean, this was just one data series, two sectors, the economy is even larger, so there are more effects. I just showed one very important effect. And that's the question, how and energy, especially going into recession, are then maybe the other factors you need to analyze in regards to the side effects of what that could impact going forward. So the way you phrase your question, I would totally agree. However, I'm not here to try to give you an answer on that, because I'm not an expert in those different areas now. So it was just a pure psychoanalysis. So please excuse if I cannot comment on real business perspective on that. We would need to run individual psychoanalysis on energy, oil and gas to now complement that analysis. Yeah, I know you're interested in the MOVE index and other data series, but please allow me to put this into another session. And I must update on that, but I think I want to keep it on that subject for now. We're running 45 minutes, and I think I just wanted to inspire you on that specific topic, not getting too much into different topics today. Right? So, thank you for joining this episode. I hope you liked it. Leave me a comment as always, and I want to see you next time on Cyclic TV. Yeah, right? Thank you. Have a nice week.